The recent incident of the Chinese spy balloon being shot down this week was quite a spectacle, much like the government's announcement of a mortgage rate drop last week. Similar to how the Chinese spy balloon was spotted soaring high in the American skies, the mortgage rates had been soaring high for homeowners. But just as the military took swift action to bring the balloon down, or did they? The government took quick action to bring the mortgage rates down as well for homeowners. The whole event was like a game of whack-a-mole, with the government and military taking turns knocking down high-flying targets. In the end, both the spy balloon and the high mortgage rates were grounded, much to the relief of all Americans. Mortgage rates showed a slight decrease this week as the Federal Reserve's smaller interest rate hike indicated positive development in tackling inflation. While China's latest attempts at a spy balloon was shot down, Freddie Mac reported that the 30-year fixed-rate mortgage averaged 6.09% in the week ending February 2nd, which was a decrease from the previous week's 6.13%. This marks the lowest mortgage rate since September of 2022, nearly 1 full point below the peak of 7.8% of last year, reached in November of 2022. Meanwhile, the Chinese spy balloon may have hit rock bottom after getting shot down, but at least it won't have to worry about a ballooning mortgage payment. The Federal Reserve approved a quarter-point interest rate hike on Wednesday, and it was such a small increase that it was barely noticeable. It was like trying to fill a swimming pool with a teaspoon. But the gradual pace is a clear sign that the central bank is patting itself on the back for its progress in controlling inflation. Meanwhile, mortgage rates are like a roller coaster. They tend to follow the yield on 10-year U.S. Treasury bonds. When Treasury yields rise, mortgage rates go up and make homebuyers scream. And when they drop, mortgage rates follow suit and everyone cheers. It's like a never-ending amusement park ride, and the Fed is the one controlling all the buttons. As inflation pressures continue to ease, mortgage originators have also decreased borrowing costs. According to George Ratu, Realtor.com's manager of economic research, the Fed's actions have temporarily kept mortgage rates stable, making it easier for people to buy their own house without having to sell a kidney or two. Rates will remain around 6% for the next few weeks, so borrowers better act fast before the Fed decides to give the rates a small nudge. The Mortgage Bankers Association, MBA, is forecasting a modest decrease in mortgage rates throughout 2023, with the estimated end rate closer to 5%, making it the perfect time to buy a house. Reports on jobs and inflation also play a role in determining mortgage rates. Despite the Fed's effort to cool the economy, the labor market remains tighter than a pair of skinny jeans after a Thanksgiving feast. With 11 million job openings reported in December, it's no wonder mortgage rates are feeling the squeeze. Housing economists and those in the mortgage market are eagerly awaiting the next inflation report like a kid on Christmas Eve, which is due on February 14th. They hope it will show whether the pace of price hikes has finally slowed down or if we're still in for a wild inflationary ride. Lower mortgage rates have been the gift that keeps on giving to the housing market, taking the financial burden off of home buyers and putting it on their shoulders instead. January's housing market data showed a growing number of homes for sale, meaning buyers can now take their time choosing the perfect Adobe, or even go home empty-handed because there's too many options. And with prices down 11% from their peak in 2022, it may be a buyer's market in some cities across the U.S. But don't forget that the affordability is still a primary challenge, especially for first-time buyers who are probably still paying off their college loans and now having to worry about affording a home as well. Folks, it's time to get serious about buying a home. Unless you have 20% down payment and a credit score so high that even the FICO gods are in awe, then you better brace yourselves for higher mortgage rates. But don't worry, if you're among the mere mortals with just average credit, then you'll be happy to know that the average mortgage rate, according to Freddie Mac's survey of thousands of lenders, is a 5.99%. So grab your calculators and let's see if you can afford the American dream. It's been a wild ride for both the Chinese spy balloon and the American housing market, where the mortgage rates are more unpredictable than a Chinese weather balloon floating across the entire United States. Just when you thought the rates were all settled in with a big round 6%, suddenly they drop down like an Air Force jet taking down a Chinese spy balloon over the Atlantic Ocean. This week, the mortgage rate started off decently at 6.21%, but on Wednesday, Fed Chair Jerome Powell sent shockwaves through the bond market with his words, causing yields to plummet and mortgage rates to drop. According to the COO of Mortgage Daily News, Matthew Graham, we can expect the rates to take measured steps downward as long as the economy and inflation data is there to support them. This means, like a slow and steady tortoise, the rates might make it into the mid 5% range, but don't hold your breath for a quick sprint into the 4% range. It's like trying to catch a falling star. It's possible, but it may take some time. So let's sit back, relax, and enjoy the ride as we watch the rates slowly but surely make their way down. It's also like a game of whack-a-mole in the housing market, where just when you think you've got the rates under control, bam, they change again, leaving you feeling like you just got hit on the head with a mallet. But hey, it's all part of the excitement, right? So hold on tight, folks. It's going to be a bumpy ride filled with Chinese spy balloons and unexpected rate drops. Thank you for watching. Don't forget to like and subscribe, and I'd love to read your comments. I'll see you on the next video.